You watch a sovereign wealth fund drop 14.7 billion euros on a German chemical plant, and your immediate assumption is that you are witnessing corporate expansion. Your assumption is inverted.
You are not watching a wealthy state expand.
You are watching a trapped state execute an emergency evacuation of its capital.
I mean, the global market looks at an entity like XRG, the $150 billion transnational arm of Abu Dhabi's national oil company, and analysts classify it as a diversification vehicle. They track the capital flows into Europe and America and assume they are watching an oil giant play the energy transition.
The official corporate profiling designates them as a financial architect building a post-oil portfolio. Look at the physical trigger that shatters that assumption, February and March of 2026.
The Iran-Israel escalation, it effectively closes the Strait of Hormuz. We have the data from the International Energy Agency. United Arab Emirates oil production plummets from 3.39 million barrels a day down to 2.02 million.
Nearly 40% of their output just paralyzed. The export vessels are trapped.
The physical infrastructure generating their wealth is sitting in a kill zone. The billions suddenly pouring into Texas LNG facilities, Austrian polymer conglomerates, German chemical plants, these are not surplus investments.
They are a structural hedge against geographic annihilation. The mother company cannot move its pipelines out of the Persian Gulf, but it can move its sovereign liquidity.
How does a state buy its way out of a war zone and into Western critical infrastructure without triggering every national security alarm on the planet?
The European defense mechanism provides the first illusion of security. I mean, the European Union's foreign subsidies regulation, the FSR, was engineered specifically to stop state-backed monopolies from devouring European industry.
Brussels built this weapon in 2023 primarily to guard against Chinese state capitalism. When XRG moved to acquire Covestro for 14.7 billion euros, the European Commission stepped in.
The investigation flagged that the Abu Dhabi National Oil Company operates with an unlimited state guarantee. They have sovereign bankruptcy immunity under UAE law. The regulatory firewall worked, forcing a standoff.
The entire European regulatory posture rested on a single load-bearing assumption. The assumption that sovereign immunity is the most sacred asset a Middle Eastern state possesses.
Sovereign immunity protects a state from foreign lawsuits. It is the ultimate legal force field. The European Commission expected XRG to balk at exposing its internal financial mechanisms to European jurisdiction.
A state does not simply hand over its financial autonomy to a foreign regulator.
XRG simply abandoned the immunity.
They legally bound themselves to United Arab Emirates insolvency law. They effectively stripped their own absolute shield, and they surrendered a decade of access to Covestro's green energy patents.
You are missing the critical lever of the exchange. They gave up a theoretical legal defense to execute a 95.1% squeeze-out of Covestro.
Well, you need to define a squeeze-out for the listener who might hold European corporate stock. That is not a standard merger. That is an execution.
Once an entity crosses the 95% ownership threshold under German law, minority shareholders lose their right to hold out. They are legally forced to sell their shares.
XRG did not negotiate for total control of Covestro. They triggered a mechanism that legally mandated minority capitulation.
The surrender was a calculated Trojan horse. By giving the European Commission a bureaucratic victory on paper, XRG traded a theoretical legal shield for physical dominion over the backbone of Europe's chemical supply chain.
A state only surrenders its legal immunity when the purchase grants a higher form of sovereignty.
Covestro is not merely a factory. It is the industrial base for European manufacturing. Everything from automotive polyurethanes to insulation materials for the continent's housing grid relies on those facilities.
XRG operates through the Supreme Council for Financial and Economic Affairs. They synthesize state power and transnational capital. They evaluated the FSR requirement and determined that controlling German chemical infrastructure was worth a tactical retreat on bankruptcy law.
The European Union achieved behavioral compliance at the cost of its industrial grid. The architecture of this evacuation relies on a strict jurisdictional hierarchy to absorb these blows.
The capital originates in the Abu Dhabi Global Market, the ADGM. The head office operates under English common law. It pays zero corporate tax and is structurally shielded from external audits by hostile nations.
The capital is safe at the core.
The ADGM provides the fortress. The localized special-purpose vehicles provide the weapons. Explain to the listener how an SPV functions in this exact scenario. When they moved on Covestro, they didn't attack directly from Abu Dhabi.
They deployed ADNOC International Germany Holding AG, registered in Cologne. A special purpose vehicle is a disposable corporate shield. It isolates the parent company from direct European liability while allowing the German entity to execute the public tender offer.
If European regulators attempt to penalize the acquisition, they are illegally fighting a German corporate entity, not the sovereign state of the United Arab Emirates. The parent company remains untouched.
The European map makes sense if you assume a regulator can be bought with a legal technicality. The American map presents a harder target.
The Committee on Foreign Investment in the United States, CFIUS, operates with a much blunter instrument than Europe. It automatically blocks direct sovereign takeovers of critical energy infrastructure.
On paper, the American grid appears completely secure from Middle Eastern state capture.
The fatal flaw in the CFIUS mandate is the definition of direct control. XRG never attempted a direct takeover.
The Department of Energy filings reveal a different geometry entirely. They acquired 11.7% in Phase 1, then another 7.6% in Phase 2 of the Rio Grande LNG project in Texas.
Minority stakes do not trigger automatic CFIUS annihilation.
They used an opaque shell called a Raven Holding Company LLC, registered in Delaware.
A Delaware shell company does not blind the federal government. CFIUS has subpoena power. They can trace the capital back to the Abu Dhabi Global Market.
The shell is not the mechanism.
The mechanism is where they park the shell.
They park their sovereign capital inside American megafunds, BlackRock and global infrastructure partners.
The strategy does not involve fighting the American financial system. They are wearing it as camouflage. BlackRock and GIP manage trillions of dollars of domestic American pensions and institutional wealth.
By embedding their minority stakes within these specific investment vehicles, XRG forces the U.S. government to attack its own foundational financial institutions if it wants to strike at Abu Dhabi's capital.
This structure bypasses the CFIUS tripwires, securing 20-year liquefied natural gas contracts designed to feed the artificial intelligence data center boom.
The listener needs to understand the physical reality of the Rio Grande LNG project. These are massive coastal facilities designed to supercool natural gas into liquid for global export.
The artificial intelligence sector requires constant, uninterrupted baseload power. Wind and solar cannot provide the continuous gigawatts required to cool vast server farms.
Natural gas is the only immediate physical bridge. XRG positioned its evacuated capital precisely at the choke point of the next decade's most critical technological race.
You don't fight a national regulator. You buy the exact domestic institution the regulator was built to protect, and you operate from inside it.
The methodology scales across multiple geopolitical zones, starving the host nations of their own resources. In Austria, they didn't just buy shares.
They merged Borouge, Borealis, and the Canadian Novia Chemicals into Borouge Group International, a $60 billion entity.
The Austrian state, through its holding company OBAG, is now locked into a 50-50 consensus with XRG to maintain its own chemical sector.
The Austrian operation exposes the endgame of this legal geometry. Borouge Group International runs an EBITDA margin of nearly 26%.
Translate that financial metric into physical reality for the listener. EBITDA represents earnings before interest, taxes, depreciation, and amortization. It is a sterile term for raw cash generation.
A 26% margin in the heavy chemical industry is not a business advantage. It's a biological anomaly. European competitors are currently bleeding cash just to keep the boilers firing, decimated by the loss of cheap Russian pipeline gas.
The European chemical manufacturers cannot compete with a rival directly subsidized by Abu Dhabi's sovereign raw materials.
The European Union is slowly being starved of its own chemical independence. Look at how this control manifests during a crisis.
In Egypt, XRG bought out OCI Global's share of Fertiglobe, taking 86.2% control of the regional nitrogen fertilizer network. During the summer of 2024, Egypt experienced a severe domestic gas shortage.
The Egyptian government was forced to shut down domestic factories and plunge entire city blocks into rolling blackouts to ration power. Citizens in Cairo were without air conditioning during lethal summer heat waves.
Yet, the Fertiglobe facilities kept running. Their production volume dropped by merely 2% year over year.
This is the exact mechanism of sovereign capture. XRG possesses the geopolitical leverage to command preferential access to a starving state's energy grid.
The host nation penalizes its own domestic industry and its own citizens to ensure the transnational operator remains fully supplied. The foreign capital buys priority over the native population.
The priority extends far beyond North Africa. Watch the map expand into the Caspian Sea and the African coastline. In February 2026, XRG buys 12.5% into the southern gas corridor in Azerbaijan.
They purchased 10% of the Rovuma deepwater block in Mozambique. They are not acting as a local reinvestor. They are constructing an alternative global energy architecture that entirely bypasses the Strait of Hormuz.
The global narrative required careful conditioning before these acquisitions could occur. I mean, during the CAPI 28 Climate Summit, XRG's chairman, Sultan Al-Jaber, positioned the entire corporate empire as the vanguard of the energy transition.
The messaging focused relentlessly on hydrogen, carbon capture, low-carbon ammonia. The ESG markets, the environmental, social, and governance funds, along with global climate institutions, embraced the pivot.
It legitimized the corporation in the eyes of Western regulators.
The timeline exposes the cynical efficiency of that narrative. The exact moment the Strait of Hormuz chokes in early 2026, the green rhetoric evaporates.
XRG's chief investment officer abruptly announces the evaluation of 29 massive deals strictly focused on traditional U.S. natural gas.
The hydrogen transition is discarded. The second physical survival requires tangible hydrocarbons. The cognitive dissonance of the chairman of a national oil company presiding over the world's premier climate summit was not a mistake.
It was the strategy. The COP28 climate agenda, bolstered by Western public relations firms like Edelman and Brunswick Group, was never an ecological commitment. It was an operational shield.
It neutralized ESG resistance and human rights NGOs like Amnesty International just long enough to construct the Bruges Group international monopoly and secure the Mozambican gas blocks.
The green narrative was the anesthetic applied before the hydrocarbon surgery.
The West wanted to believe the public relations campaign because it validated their own climate goals. Meanwhile, XRG integrated its board of directors with heavyweights like John Gray of Blackstone and Nassif Sawiris.
They ensured a continuous pipeline of Western institutional liquidity to fund the capture of traditional energy assets. The alarm was silenced by capital.
Power isn't winning a regulatory battle. It is making your opponent believe their paperwork is a substitute for your physical control.
We have to identify the limits of the available intelligence. The structure we are analyzing contains genuine anomalies that cannot be neatly resolved.
The design is formidable, but it relies on legal fictions that are beginning to fracture under the weight of reality. Two distinct blind spots threaten the stability of this entire architecture.
First, the BlackRock and Global Infrastructure Partners shareholder agreements regarding Rio Grande LNG remain sealed. We know XRG holds the minority equity through Raven Holding Company in Delaware, but the actual operational control hidden within those private contracts is a black box.
The degree to which Abu Dhabi dictates the operational flow of Texas LNG is completely obscured by American corporate secrecy laws.
The American judicial system introduces an uncontrollable variable. The South Texas Environmental Justice Network successfully lobbied the D.C. Circuit Court to temporarily vacate the Rio Grande LNG permits.
Even with Delaware shell companies and BlackRock partnerships, a localized grassroots organization managed to paralyze an $8.5 billion sovereign investment.
XRG can co-opt the European Commission with tactical bankruptcy concessions, but they cannot control a federal appellate judge responding to domestic environmental litigation. The logic of state-level capital breaks down when it encounters decentralized legal warfare.
The second anomaly centers on the June 2026 European Union draft for secondary sanctions. The EU targeted the Russian shadow fleet operating in UAE ports.
ADNOC's maritime logistics overlap heavily with those exact port operations. If Western regulators apply OFAC or EU sanctions to ADNOC's physical shipping infrastructure, it could freeze XRG's entire United States and European empire.
You are invoking OFAC without explaining the lethal nature of its mandate to the listener. The Office of Foreign Assets Control is the financial executioner for the United States Treasury.
If they sanction a single vessel in the Persian Gulf, any global bank that processes a transaction for the owner of that vessel loses its access to U.S. dollars. The entity is financially erased from the global banking system overnight.
The intelligence does not reveal if XRG can mathematically insulate its foreign assets from its mother company's geopolitical radioactive exposure.
A localized shipping sanction in the Persian Gulf could detonate their global legal architecture. They are operating in jurisdictions where the rule of law can suddenly override strategic capital.
These blind spots are the literal fault lines of the global energy market over the next 3 years. The entire $150 billion structure depends on the Delaware courts and the European Sanctions Office remaining blind to the connection between the localized assets and the sovereign core.
The West believes it is successfully regulating foreign investment because it extracts minor concessions. A patent shared in Munich. An ESG pledge delivered in Geneva.
While Europe and America celebrate these bureaucratic victories, A Middle Eastern power anticipating the physical destruction of its homeland has successfully wired itself into the life support systems of Western industrial survival.
The question is no longer whether they manage to evacuate their wealth from a burning region. The question is what happens when Europe and America realize they sold the blueprints to their own industrial grid to an entity that is rapidly running out of time.